Hello friends, good morning. Welcome to the Block Thrasher Daily Crypto Update. Simply the best place to get a daily overview of what is happening in the cryptocurrency space, the hottest news of the day, with some commentary, with some analysis, and a little bit of education mixed in. Got some good stuff to talk about today. We're going to do part 3 as we look at inflation, the insidious thief, inflation. But before we do that, let's jump into the market and see what's happening, see what's going on. Total market capitalization is down negative 2.6%. The market is just dancing back and forth, weaving, bobbing up and down. It's kind of like a lilt. It's lilting, L-I-L-T, a rhythmic swing or cadence, L-I-L-T, our word of the day. And that's exactly what is happening with the market. It's up a little bit, it's down a little bit, it's up a little bit, it's down a little bit. Just look at Bitcoin right now, down 3.4% in the last 7 days, down 1.2% in the last 24 hours, but up 1.3% in the last hour. So here we go with the swing, back and forth, up and down. It is Friday, July 2nd, 2021, 7:23 a.m. here in the beautiful state of not Montana, Wyoming. I'm in Cody, Wyoming. Actually staying in Montana. So I just cross over the border back and forth, back and forth. Right now I'm actually currently in Wyoming though. All right, let's take a look at the market before we jump into all the other things that we have to talk about today. We've got a great show for you though. I think you're gonna enjoy it. Bitcoin, $33,414.73. As we mentioned earlier, down 3.4% on the week. Total market capitalization also down 2.6%. Dominance, Bitcoin dominance, 44.3%. Ethereum at 17%. And gas prices are low. Standard GWAY, 12 GWAY for Ethereum transactions. Not bad at all. Ethereum is up 4.1% on the week, up 1.4% in the last hour at $2,068.19. And we've actually got some good stuff to look at regarding Ethereum. Let's just do that before we move on with the rest of the market. Ethereum balances on exchanges see a historic drop. This is a good thing. And this is some data coming out of Sentiment, one of my favorite analytics companies. They say that this lowers the risk of a major sell-off. Analytics data vendor Sentiment has published a tweet saying that Ethereum balances on multiple crypto exchanges have seen a historic drop. The overall balance of Ethereum, the second largest cryptocurrency on crypto trading platforms, has declined and went below 18%. Now that's the lowest figure since November of 2018. Sentiment believes that by moving their Ether out of exchanges into cold storage wallets, users have reduced the chances of a major ETH sell-off in the near future. That makes a lot of sense. We agree with that. At the time of writing this article, Ethereum is trading at $2,061. Earlier this year, Ethereum managed to hit an all-time high of $4,362. Yeah, we've seen like a 50%. Yeah, that hurts. On May 12th, the all-time high of $4,362, as per the data provided by CoinMarketCap.com. Now, we'll continue to see what happens here, but good analysis looking at the amount of Ethereum that is being taken off of exchanges and put into cold storage. So Ethereum currently at $2,067.98. What about Cardano? Cardano is the only crypto in the green across the board in the top 10. Not much, but it's in the green. Up 0.3, at least according to CoinGecko. Up 0.3% on the week, up 1.3% in the last 24 hours, and seen a nice little boost in the last hour. Up 4.4% to $1.36. We got some news for Cardano too. Let's just take a look at that really quickly before we continue on with the rest of the market. Might as well just knock these things out now, right? Here's the deal. Over $30 billion in ADA has been staked as Cardano gears towards the largest network transformation that it has seen as of yet. So a ton of ADA is being staked. The vast majority of the supply. They've got more details here. Let's look at this really quickly. Cardano's ADA holders have staked 43.3 billion ADA, worth over 31 billion, as Cardano prepares to implement the last phase of the Alonzo smart contract hard fork. Wait a second. This doesn't make any sense. Cardano's more than $1. It's $1.39, and they staked 43.3 billion ADA. How is that only worth 31 billion? Somebody's got something off a little bit here with their math. That would be over 43.3. That would be over 43 billion. That would be significantly higher. Oh, well. Sometimes the, the data on these, these articles, but some of the facts, these facts are certain. The fact that, as they state in the next thing, 71% of the total circulating supply has been staked, as reported by Cardano Pool Tools. There's a couple other sites that I've been following. I think it's called pooltool.io. Has all kinds of really useful information. Let me just verify that that's right before I move on, because I don't want to state something incorrect on the show here when I can check it out fairly quickly. Yes, pooltool.io. There's these 3 Cardano staking pools, Love, Pega, and Sky, that have come together and built this tool. And it's a fantastic pool that provides all kinds of data and information about Cardano. And they show that the total staked is 31.47 billion, 71.66%. So 43.9 billion is the total supply. That must be the number that they were quoting, because this isn't showing the actual total number of Cardano staked, but the dollar value of Cardano being staked. 31 billion. That's quite impressive. You can check this site out if you want, Pool Tool. And then there's a few others. And as they're stating here on this article, they are pulling the data from Cardano, the Cardano Pool Tool. So 71% of the total circulating supply staked. The total staking addresses have also increased by over 11%, from 600,000 to, which was achieved in early June, to 670,000. So an additional 70,125 addresses have been added. The addresses are staking on 2,665 active ADA pools out of the total 2,817 staking pools on a network. So look at all these numbers. Just things are looking incredible. I mean, just fantastic for Cardano. 71% of the supply staked. We're getting close to almost 700,000 staking addresses. Which, and there's no real reason that I can think of why people would be staking, like the same person would be staking on separate addresses. Could be, but there's no real advantage to that, technically speaking. So, not that I can think of. If someone out there is aware of one, please correct me and let me know. But we're at 670,000, so that's a lot. That's a lot of people, and the decentralization of this network is phenomenal. With 2,000, we're getting close to, excuse me, getting close to 3,000 staking pools, which is one of the claims that Cardano is making, is that they're going to be one of the most decentralized, if not the most decentralized network. The Alonzo project is part of the upcoming Goguen era, dubbed the era of smart contracts, and it represents the necessary upgrades that Cardano has to implement to support smart contracts. Alonzo consists of several testnet phases, which are color-coded into Alonzo Blue, which went live on May 27th, Alonzo White, and Alonzo Purple. Cardano's smart contract era, it's coming. During the successful launch of the first Alonzo testnet on May 27th, Cardano related that Alonzo will finally put the network in a position to complete and outperform other platforms like Ethereum, Solana, Binance, and Polkadot. It's going to be incredible to see, because Solana is very high performance. I mean, Ethereum and Binance and Polkadot, that's, and Polkadot's pretty high performance too, but I know that's not much of a surprise. In mid-June, a spokesperson from Cardano's parent company, IOHK, said that Alonzo could run a simple smart contract. The official launch of smart contracts is expected to occur sometime in August. Well, it's July 2nd now. So if things go according to expectations, we're looking like a month from now. Man, if there could just be this tidal wave of adoption, and what I'm trying to say here is this tidal wave of growth, right, with Cardano. When the smart contracts go live, there's a whole bunch of, and you know what? I've got to do this podcast and I've got to release this article. I've got this article written. It's like 90% written on the Cardano ecosystem and a whole bunch of projects that are launching on this. And there's like 20 plus or something. When Alonzo finally launches and the smart contracts go live, or is it Goguen? Sometimes I just get mixed up on what these are. We just read the upcoming Goguen era. There we go. Dubbed as the era of smart contracts. All right. Alonzo's part of Goguen. When all this happens and all this stuff kicks in, and here's the thing. There's a lot of people out there who really believe in Cardano, but are also somewhat apprehensive, because there's no smart contracts actually been launched, and things have been taking so long in the development process because of this rigorous method. So there's a lot of naysayers. There's a lot of people throwing out FUD. There's a lot of people, but there are some people that really do want to see it happen. They do believe, like they see the potential, like they understand, but they're still just kind of like waiting on the sidelines. And when things start to really take off, and if everything is delivered as promised, Cardano is just going to go nuts. It's going to go absolutely insane. It's going to be crazy for so many reasons. We've covered a lot of that if you've been listening. Come the end of the Shelley era, we expect Cardano to be 50 to 100 times more decentralized than other large blockchain networks, with the incentive scheme designed to reach equilibrium around 1,000 stake pools. However, we're already well over 1,000 stake pools. I think that was a quote pulled from something old. However, Shelley will eventually give way to another hard fork, which will usher in the Goguen era, which will add the ability to build smart contracts. When complete, it will allow users from technical and non-technical backgrounds to create and execute functional smart contracts on the Cardano network. Cardano has 5 main areas. All right, we don't want to cover all of this. We talked about this we mentioned the other day that Cardano got listed on Nexo. Actually, I don't think we mentioned it. I think I just posted that in the Facebook group. On June 30th, digital assets management firm Nexo added ADA to its platform due to customer demand. According to the firm, its clients will now have an opportunity to buy ADA on the platform, earn a yearly interest of 8%, and borrow against ADA for only 6.9% APR. So that's cool. So Nexo is sort of like BlockFi and Celsius and some of those others. On the same day, one of Cardano's 2 primary staking wallets also celebrated its first anniversary. All right, enough about Cardano. We already know. Everybody already knows that we believe in Cardano here at blockthrasher as one of the, if not potentially the one of the leader in the crypto space one day. All right, what's happening with Binance Coin? Binance Coin is $281.22, down 8.6%. Oh, that is interesting. That is interesting. I don't know why I didn't really notice that. There's been a flipping happening here. Cardano has surpassed Binance Coin. Cardano, this always happens on these sites. Like, look at this. Cardano is market cap is higher than Binance Coin at the moment. It still says number 5 though, even though it's sorted higher than Binance Coin. So if you're looking at CoinGecko.com right now, if you pull out Tether, Cardano's number 3, Binance is number 4, but they've got it listed as 5 and 4. It's quite funny. It seems to happen a lot. Not exactly sure why, but it's almost like there's this apprehensive thing of listing Cardano as number 4, which is really number 3 when you take out stablecoin Tether. All right, Dogecoin is 24 cents, XRP 64 cents. Everything in the red. Polkadot down 7.2% on the week, $15.05. Bitcoin Cash $487. Uniswap $17.54. Litecoin coming in at number 13. $1.33. Well, that'd be nice. $133. Solana $32.49. Chainlink $17.66 and Polygon $107. Look at that. 3 super solid projects. 14, 15, 16. They've all been pushed down in market cap though. Each and every one of those has been a little bit higher. Well, I think Solana only hit 13, but it's currently at number 14. All right, moving on. Let's take a look at the rest of our stories today before we wrap up, or not wrap up, but get to our discussion on inflation. Insidious thief. Crypto ownership. Okay, this is interesting. This coming out of the Bank of International Studies and the Bank of International Settlements, right? The BIS. The BS Bank of BIS Bank. Oops, sorry. Don't forget that I. The BI Bank of International Settlements. I love this story. I'll tell you what. I don't trust a single thing the Bank of International Settlements does. I don't trust their analysis. It's completely jaded. I mean, it's like, what would be a good illustration of this? It's like asking a donut shop owner, if donuts are healthy for you. Now, if you have an objective donut store owner, obviously, maybe a better example would be something like asking the creators of Roundup and Monsanto if it's unhealthy. Let's go back to the donut. I guess that one's more clear. The donut shop owner, are donuts healthy? Should people be eating donuts? Well, if he's thinking objectively, of course he's going to, but yeah. He wants business. See, there's a conflict of interest. Anyway, there's definitely a conflict of interest here when it comes to anything the Bank of International Settlements has to say about cryptocurrencies, because the Bank of International Settlements is exists for the support, the strengthening of the central banks, right? So, all right, but here's what they say. Let's just look at what they say, and then we'll talk about it. Because crypto ownership has there are a couple things they say here, by the way, that are like, okay, I can get on board with that. Sure, that sounds good. I agree with that. All right, crypto ownership has nothing to do with distrust in fiat. This is their primary principle. Like, crypto ownership has nothing to do with distrust in fiat. Have they talked to anyone in the cryptocurrency space? Have they gone and looked at anything that any of the founders of any of the cryptocurrencies have said? Have they read the history of Bitcoin and its creation and why it was created? Have they looked at the origination of cryptocurrency? That Bitcoin was created after the 2008 Great Financial Crisis, and why? Have they looked at anything anybody's ever said about the concern about central banking system and the Federal Reserve and the fiat currency and its unlimited supply and its mismanagement and seriously? It's like, we're just going to ignore all of this and just say what we want to say. All right. Cryptocurrency owners, here they say, are generally more educated than the average. Okay. Now that I can agree with. Okay. Obviously. Duh. Can't believe they're conceding that point, though. According to a new study by the Bank for International Settlements. But there's a reason behind it. See, they're like that this is gaslighting right here. They're like that manipulative, gaslighting bad ex maybe that you used to have, that used to like try to convince you that what you knew was true wasn't true. And sometimes people do this very effectively. This is what's happening right here. Cryptocurrency owners are generally more educated than the average, according to a new study by the Bank for International Settlements. The Bank for International... I still can't believe they would agree to this. Okay, the bank stated, the Bank for International Settlements, the BIS, a global financial institution owned by some of the world's biggest central banks, is trying to dispel the theory that cryptocurrency ownership is linked to distrust in traditional finance. Good luck with that. On Thursday, the Bank of International Settlements published a paper on the socioeconomic drivers of cryptocurrency investments in the United States, employing representative data from the U.S. Survey of Consumer Payment Choice. Representative data from the U.S. Survey of Consumer Payment Choice. All right, let's go to the U.S. government survey of... of course, it's going to be jaded information. You know, the only way I can see they came up with this kind of conclusion that they're going to, is that they went on like... This survey was taken by a bunch of people who got into the DOGE thing this last year, trying to make a quick buck. That would make sense. Anyway, the BIS argued that distrust in fiat currencies like the US dollar has nothing to do with investor motivation. Now look, if they were to say it's not the primary factor, people wanting to get rich quick or whatever it was, okay, I could get on board with that. There might be some truth in that because of, maybe the vast majority of people in the crypto space aren't ideologically driven, maybe they don't even understand. A lot of the people that were on social media that had a friend at work that said, hey, you got to buy Doge. Where are they going to? A lot of the newer people that just got introduced, they don't understand any of the stuff behind it. They're just like, oh, I can make some money. Let's do it. This sounds like kind of like a fun game, way to gamble. I mean, I buy lottery tickets. I might as well, throw something into Doge or Shiba Inu or whatever it is, right? So, but if you listen to the actual influencers out there, I don't care if you're talking about Richard Kiyosaki from Rich Dad Poor Dad or Michael Saylor or even the more well-knowns like Elon Musk or Cuban or Mr. Incredible or anybody. They all talk about the problem with the Federal Reserve and the financial system and the intermediaries and all the fees and on top of it, the inflationary concerns and on and on and on and on it goes. This is just insane. This is just nuts. But anyway, they say distrust in fiat currencies like the US dollar has nothing to do with investor motivation to hold cryptocurrencies like Bitcoin, stating, quote, demand for cryptocurrencies is not driven by distrust in cash or the financial industry. Given that there are no differences in the, here's their logic. Listen to this. Given that there are no differences in the perceived security of cash and offline and online banking, we can thus preliminarily disprove the hypothesis that cryptocurrencies are sought as an alternative to fiat currencies or regulated finance. Say what? So because there are no differences in the perceived security of cash, I guess they're talking about physical cash, and offline versus online banking. What? This has nothing to do with anything. People's concern with the traditional financial banking system isn't a security concern. Nobody's concerned that going online, doing their banking online is less secure. I mean, maybe you got, I don't want to say nobody, or maybe you've got some people, very, very few people still at this point who are uncomfortable with banking online. So they're, but I mean, these people typically would be from a demographic that would be much, much, much older and very, very small, that are still going into the bank or dealing with paper cash only. I mean, no, everybody uses debit cards and credit. I mean, yeah, the reasoning here is just ridiculous at best. The authorities stress that cryptocurrencies are not sought as an alternative to fiat currencies or regulated finance, but instead are a niche digital speculation object. See what I'm saying there? So they're basically saying, like, this is the gambling. This is like throw it in, hope you get rich, rich kind of thing. Like, just very speculation. Okay, all right. The BIS noted that from a policy perspective, the overall takeaway of the analysis is that investors' objectives are the same as those for other asset classes. So should be the regulation. Right? And again, this is an attempt to classify cryptocurrency as just like a stock, as an equity, as an investment. Totally missing. Like, these guys are totally ignorant. They probably aren't. I'll give them that. But this is gaslighting. They are spinning this thing to their advantage. They don't want to acknowledge the fact that cryptocurrency can be a phenomenal payment system, which cuts out the banks, cuts out the intermediaries. It's faster, it's more secure, it's more reliable, it's cross-border, it's programmable money. Like, smart contracts can do crazy things, and we're starting to see that. And the future is bright, and the future is incredible. We talk about it often on here. The things that are going to be, this is transformational technology. Like, so many people that haven't taken the time to just actually study or research this stuff don't understand it, that this is going to change the lives of people in Africa, of people in third world countries, people that haven't been able to get to much of it. They're not even concerned about trusting. It isn't an issue of trusting the traditional financial. They can't even get to the traditional financial system. I'll give you an example. Even people here in the United States. So let's just say that you're a very successful entrepreneur. You have a lot of money because you have successful businesses, but you've gone through 3 or 4 bankruptcies in the past, right? And maybe you can't get a loan from a bank. They won't touch you because you haven't, your credit score is incredibly low because you had some bad things happen in the past, but suddenly you become very successful. You got a bunch of money now, right? You can't go out and get a loan. You want to buy a house. Well, guess what? You can take your Cardano and go to Nexo, just like in the article that we read before, and you can throw up. So you've got a couple $100,000, maybe $500,000, $1 million of crypto, and you want to keep the crypto because there is that speculative nature of it, or you believe that the space is continuing to grow and you want to keep it because 4 years from now the value of it is going to increase by 4, 5, 10 times or whatever. So you want to get a loan. So you can use your crypto with Nexo or BlockFi and these others and use it as collateral and get a loan. And go out and buy that house and make the payments and not sell your crypto at the same time. Where you go to traditional financial system and you try to get a loan from a bank and they're going to say no. Or maybe you've got this incredible business idea. You've already proven to yourself that you can make killer amounts of money with this business idea because you're already doing it on a smaller scale and you want to scale up. And you go to the bank and they say, no, we need this and we need that and we need this and we need that and that, right? Well, what does crypto allow you to do? Crypto, just exactly the Nexo thing. And there are other things coming like that where there are going to be people that are going to be able, in a decentralized smart contract DeFi way, to loan you money. Maybe it's like micro amounts. Maybe you've got 10,000 people that loan you $5 or whatever, right? And they're going to earn rewards. And this is all built in the smart contract. They may not even know who you are, but they're willing to take that risk. They're willing to throw $5,000 in some sort of like startup system, kind of like a GoFundMe, right? These are the kinds of things that are being made, that are being developed. Forget the banking system, right? Which is all about like, you play by our, what the banking system essentially is designed to do. And the credit system is, you have to give them interest. Like, you want to build your credit. That's an interesting way of, thinking about it too. You got to go and put a balance on your credit card and just make the payments every month. That's how you build your credit, right? Because they need to be making money off of you ultimately at the end of the day. That's what they want. That's what they need to see from you, right? And then when you don't screw up, maybe you're young, maybe you're going through a bad season of your life, maybe you're going through a divorce, and so your business fails or whatever. That doesn't mean that you're not a productive, that doesn't mean that you're even an unreliable person. You just had a season. Everybody has seasons in their life, right? And then they turn things around. They grow up. They get rid of the bad season. They grow. People change, and in good ways often. And so cryptocurrency, anyway, I want to follow definitely. Anyway, let's finish this up here. The authority stressed that cryptocurrencies are not sought as an alternative to fiat currencies or regulated finance, but instead are initial speculation. Bull crap. BIS noted that from a policy perspective, the overall takeaway of the analysis is that investors' objectives are the same as those for their assets. Oh, we already read that garbage, right? The BIS paper also outlines major correlations between crypto investment choices and the level of education and income, suggesting that cryptocurrency owners are generally more educated than the average. Well, you don't say. Ether and XRP investors show the highest education level in the Bank of International Settlements analysis, while those owning Litecoin, LTC, were the least educated, with Bitcoin owners ranking in the middle. And it's so funny because they didn't actually do this analysis. It states here right in the article that they got this information from the U.S. Survey of Consumer Payment Choice. The new report brings significant relevance that cryptocurrencies like Bitcoin pose no threat to traditional finance tools, as crypto demand is not driven by distrust in cash. A number of global authorities and institutions previously expressed concerns about Bitcoin's ability to capitalize on global distrust in traditional finance. In late December, Morgan Stanley investment Ruchir Sharma argued that the US dollar's reign will likely end due to global distrust. So you have this analyst from Morgan Stanley saying the exact opposite of what they're saying. In traditional, while Bitcoin would capitalize on the lack of economics. You know what? It's just funny because they're trying to spin this thing. This is gaslighting, like I said, but man, I lost train of thought for just a second there. This is good, is what I wanted to say. It's good because they're trying to convince everybody that, look, people still trust the traditional financial system. Everybody trusts the banks. Everybody trusts the central banks. Everybody trusts the fiat. Everybody trusts the dollar. That's what it is. That's the reality. People aren't buying crypto because they don't just trust the dollar. So you know what? You can look at this two ways. On the flip side, this is just gaslighting. This is just manipulating. This is just trying to convince everybody that is what is true, right? Because these people truly believe, these elitists believe that they can create a narrative, they can put it out there and spin it, and everybody will just fall in line. They really do believe that. So that's one side of it. But the other side of it is if they really believe this, which I don't actually believe they do, but if they really believe this, then they aren't going to be concerned. And this actually goes against everything that they've said, because they've so often stated in the past, the Bank of International Settlements, that, cryptocurrency is dangerous and volatile and is blah, 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 blah. And now they're just trying to say it's like any other traditional asset that somebody's going to invest in. So even they are contradicting themselves. But if they really did believe it, that would be a good thing, because that means they wouldn't go after it. They're not going to try to regulate it away or, do everything they can to try to kill it. And, maybe they're at the point where they know they can't do that anyway. And so the strategy now is just to convince everybody that it has nothing to do. Crypto's growth and whatnot, and acceptance and adoption on it has nothing to do with people's distrust in the dollar or in fiat currencies or in cash or in traditional banking system. All right, moving on. Enough about that. Coinbase is pushing to add as many crypto assets as possible. These altcoins could soon launch on the exchange. Now, I wanted to read this to you because it's good for people to understand. There's this thing that happens in the cryptocurrency space that when a coin goes on Coinbase, suddenly everybody's like, oh, this is a solid and legit coin, and Coinbase is even listing it, and Coinbase must be approving of and advocating, blah, 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 and it's interesting because sometimes we've seen that effect. Sometimes we've seen a little known coin gets listed on Coinbase, and boom, this thing just takes off like a rocket, and then it typically drops later on. But some of the bigger ones like Cardano and some of the others, that when they got listed on Coinbase, it didn't happen because Coinbase was just late to the game. Like the adoption had already occurred. Investors were already aware of that crypto because there were some, like Cardano being the biggest example, that were like in the top 10, but still not on Coinbase. So Coinbase don't care. Coinbase, so they straight out in this article, the CEO, Brian Armstrong, talks about this, and this is an important thing to understand. Coinbase just lists things because they want to make money. They want to list as much as they possibly can. They don't do any analysis to say, oh, this is a good project. Coinbase CEO Brian Armstrong says the top U.S. crypto exchange is working to list as many altcoins as possible. Armstrong tells his 723,000 Twitter followers that Coinbase is doing its best to quickly and legally list every asset under the sun. So there you go. He says this, reminder about how Coinbase lists assets. Our goal is to list every asset where it is legal to do so. Additionally, the chief executive emphasizes that Coinbase does not decide whether to list an asset based on the supposed quality of the project. They aim simply to list any asset that meets their legal standards. Outside of our listing standards for safety and legality, we don't offer an opinion on the value of each asset. We are asset agnostic because we believe in free markets and that consumers should have choice in the crypto economy. This is how we'll have the most innovation. Translation, this is how we'll make the most money. In the same breath, Armstrong states that when Coinbase lists an asset, it is not at all an endorsement of said asset. Across several blog posts, the exchange has specifically called out a number of crypto assets that it is exploring. Since then, a number of those coins have launched on the platform. Those that have not yet debuted on Coinbase and are under consideration include Argon, Arweave, Ampleforth, Fetch, Helium, Hedera Hashgraph, Kava, Ocean Protocol, Reserve Rights, TBTC, Theta Network, UMA, Digibyte, Horizon, LivePeer, Render Token, Psycoin, VeChain. Armstrong says Coinbase is taking a close look at more than 100 altcoins as it assesses the crypto landscape. So what happens is when something goes on Coinbase, it's just that a lot of people that weren't aware of it becomes aware of it. It's kind of like a marketing thing, right? Because Coinbase is so widely used. Moving on. Let's wrap things up with our discussion on inflation coming from Kraken's intelligence team. What are the effects of inflation? Economists from the Austrian School of Economics, okay, such as Muriel Rothbard and Ludwig von Mises. Now, those are two names that you should know. Real quickly, let me just sort of summarize. You get two schools of economics out there, two primary. There may be others, but one is called the Keynesian School of Economics, and the Keynesian school believes in central banks. The Keynesian school leans towards socialism because there's a connection there. The Keynesian school believes in the central bank's ability to control. The Keynesians were behind things like the creation of the Federal Reserve and the other central banks, which are relatively new is the way I meant to say that. We're talking 1913 in the U.S. here, right? So just a little over 100 years since we've had this system in place. They believe in the central bank's ability to control the economy through, inflation mechanisms and creation of money and printing and all these other kinds of things, right? They do not believe in what the Austrian school would call sound money. There's no backing. There's no commodities to back. There's no gold backing or anything like that. Whereas the Austrian school disagrees. It goes a lot deeper than that in a lot of different ways, but that's just sort of a simple explanation so that you understand what's going on there. Now, if you want to learn more about the Austrian School of Economics, you can go to Mises.org. There's this institute called the Mises Institute, and there's a lot of brilliant, PhD level type of economists that write there and create videos and all kinds of other content. And you can also find the writings of people like Rothbard and Mises, who are no longer with us, there, their books, etc., and just tons of useful information. So I highly recommend Mises.org. Check that out, MISES.org. So these economists, Muriel Rothbard and Ludwig von Mises of the Austrian School, going back to the article here, contend that inflation is not a rise in general price level, but rather an increase in the supply of money and bank credit relative to the volume of goods and services. As such, so they're looking at the causes of prices rising rather than just saying, "Oh, prices are rising, we have inflation." As such, they argue that inflation is outright harmful because it depreciates the value of currency, raises the cost of living, imposes an implicit tax on the poorest class of people at a relatively higher rate than the tax on the richest class of people. Absolutely agree with that. Absolutely agree with that, because the richest class of people are making money through their businesses, etc., and through their investments. And typically the richest class of people, as the Bank of International Settlements just acknowledged, are in assets that are anti-inflationary, like gold and silver and stocks and crypto and bonds and on and on. So when inflation occurs, what happens is the poorest people get hurt the most. And that's where it's like that invisible tax, because bread gets more expensive and gas gets more expensive and their incomes don't rise to keep up with it. Whereas the wealthier people who own property and they own all these other types of things, as those prices go up, they're the ones that are actually benefiting from it, right? So it's a tax on, it's a greater tax. It's a greater implicit tax on the poorest class of people at a relatively higher rate than the tax on the richest class of people. Devalues savings and thus disincentivizes future savings. Redistributes wealth and income asymmetrically. I absolutely agree with everything that is stated there. That is exactly what happens. People get excited because of stimulus and we're getting money, but what they don't recognize is, and the poor people especially that need that, yeah, they need it. Okay, they need it. COVID happened. We had all this stuff happen. But what they don't understand is that it's making the richer class richer because it's driving up commodity prices and it's driving up those investments, but it's making everything more expensive, right? So it redistributes wealth and income asymmetrically, incentivizes speculation and gambling, underestimates the anti-fragile mechanisms of a free market system, and corrupts the morals of both the public and private sectors. Meanwhile, the Keynesian school defines inflation as an increase in the general price level caused by an increased money supply. Keynesian thinkers assert that inflation can yield a variety of positive and negative effects, including. All right, so we're going to take a look at this Keynesian argument. Positive, they say it causes an increase in labor supply. All right, an economy operating below its production capacity has more unused labor and resources than can be used to increase business production, i.e. economic growth. With a surplus of readily available workers, hiring competition increases, and thus it becomes unnecessary for employers to bid, quote, bid for employees by offering higher wages. In times of high unemployment, wages typically remain stagnant, and no wage inflation, i.e. the rate of change in wages, occurs. When there's low unemployment, the demand for labor exceeds the supply, and employers may need to pay higher wages to attract employees. Increasing wages forces employers to raise prices, causing further inflation. That is exactly what we see happening right now. Nobody wants to work. Walk down the street downtown somewhere in your town and look, and go into the fast food places, go to Wendy's, go to McDonald's, go to Subway. They're all hiring. They can't get anybody to work. Nobody wants to work, so they're having to raise their prices. They're having to raise their pay, right? And they're hiring people and giving them higher pay. Well, then that just translates into charging people more. Fast food is crazy expensive now. You go through the drive-thru at McDonald's with your family and you're spending 50, 60, 70 bucks, right? And the people in there, they're making more than they were, but this is causing inflation, right? So they're saying this is actually a positive thing, though, because they're saying that what this does is this increases the labor supply. Okay, so that they look at the raising prices and the raising incomes, like, oh no, it's a good thing because it means people are going back to work. But we got this interesting thing going on here, where behaviorally, not necessarily. Another positive thing, according to Keynes, is it causes an increase in aggregate demand. Because more money in circulation may lead to more spending, it can positively impact the economy by increasing demand for goods and services. The rise in aggregate demand thereby triggers more production. Positive and negative. Increase in value of scarce asset holdings, decline in value of fiat savings. Because a currency's purchasing power falls when inflation rises, so will an individual's wealth if it's parked in cash. Therefore, demand for scarce assets, Bitcoin, gold, real estate will rise. All right, so they acknowledge this. Nobody's going to hold the money. And I think that's a good thing. Nobody's going to hold their money because it's losing purchasing power. So they're going to buy things that will increase in value with the inflation. And what are those things? Bitcoin, gold, and real estate. By way of example, gold prices grew by 24% in 2009 on the back of the worst financial crisis since the Great Depression, as inflationary concerns caused investors to seek safe haven assets. However, the S&P 500 rallied 26% during the same period, outpacing gold by 2%. Though it may seem like the ETF for the S&P 500 SPX was the better investment choice at the time, This does not account for the amount of risk involved with investing in either asset. Considering the S&P 500's risk volatility relative to gold, it's clear that gold offered a better risk-adjusted return, less prone to sudden drop in value while having relatively large upside potential. Figure 2 below provides a more contemporary example on the performance of fiat currencies and scarce assets in the face of inflation by displaying the real inflation-adjusted purchasing power of the US dollar, the euro, and the Great Britain pound, in contrast with the US-denominated Bitcoin price. Though there are some immaterial exceptions, it's clear that major fiat currencies have steadily declined throughout the last 11 and a half years, while Bitcoin has inversely posted significant returns. This chart, it shows the real purchasing power of inflation adjusted, right? So if we look at the US dollar versus Bitcoin, in 2010, US dollar, $1. By 2021, 83 cents, right? Same thing with the euro. Same thing with so they're losing purchasing power. Whereas Bitcoin, on the other hand, in 2010 was 30 cents BTC to USD. Today, 30,000. Significant increase in purchasing power. Positive and negative. Gains, losses for debtors, creditors. Unhealthy inflation levels can weigh on creditors because the money they lend out will be worth less upon repayment. That's right. You know, you can use that to your own advantage too. If you have a loan, there's no reason to pay it off now. Just make the minimum payments. Unless you're trying to get out of debt. I mean, there may be some reasons if the interest rates are low, etc. But it's not just the interest rate. Something you have to factor in is that the dollars that you're using to pay that loan now have greater purchasing power than they will 5 years from now or 10 years from now. So as time goes on, unless the interest rate far outweighs the inflation rate, you're paying that loan down in dollars that are cheaper. And so you can use this to your advantage. In fact, this is one of Michael Saylor's greatest strategies right now. I mean, he's arguing that we're going to see so much inflation that if you took out a loan to buy Bitcoin, that Bitcoin is going to outpace that loan by so much on a 4-year, 5-year, 10-year. You know, if you're looking at a longer time horizon, that you're going to end up winning significantly in the long run. It's just something to think about, to consider, because this is what happens. So creditors have this concern because they know that the money that they lend out will be worth less upon repayment. So on the other hand, high inflation is a boon for debtors because the money they pay back gradually becomes less valuable. For example, if Bob borrowed $100 from the bank with a 3% annual interest rate and suddenly the economy experiences 10% inflation, Bob would pay his debts at a 7% discount in terms of purchasing power. Inflation effectively rewards borrowing and disincentivizes lending. When inflation exceptions are high, assuming no central bank intervention, nominal rates will rise to offset the long-term decline in currency value for lenders. All this is one reason that why owning a home can be such a good investment is because, you know, if you have a low interest rate, especially on that loan, you're paying off years down the road with dollars that are worth so much less, right, in purchasing power. So you're actually paying far, far less. You know, obviously that's offset by the amount of interest that you're paying. So you have to take those factors into consideration. But if there's been a lot of inflation, like we've typically seen, you're paying off that loan. And at the same time, that asset, that home, is a deflationary asset, which is going up with inflation, which means you have all kinds of equity potentially. And many, 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 many Americans have capitalized on that. And most of Americans' wealth has come as a result of that. Actually, for many, many Americans, their home has been like a great investment and an ATM, essentially. Under the right condition, governments are beneficiaries of inflation and will use it to their advantage when possible. Governments do so by transmitting monetary policies that increase tax revenues for the government, such as implementing tax hikes or selling bonds to issue debt. These incentives allow central banks to effectively cause more inflation, leading to the devaluation of the debt the government owes to investors while simultaneously collecting more taxes that will help it pay off debts, right? And this is where they're caught in the crosshairs of this reality. And this is why governments are going to pressure the central banks to continue to cause inflation. This is exactly what is happening. They're as they stated here, what they're doing is they are devaluing the currency because that then makes their debt cheaper, right? You get it. So they are paying less on that debt because they're paying with dollars that are now worth less. At the same time, getting more tax dollars and revenue from the populace. The debt to GDP ratio is a helpful metric for assessing a country's ability to pay off its debts. To calculate debt to GDP, divide government debt by the country's GDP. All right, we're going to pick up here tomorrow with a discussion on this debt to GDP ratio. That's enough for today. Whew. It's kind of some heavy stuff, but it's good stuff to understand. It's good stuff to know. And it's really important for people who are looking at cryptocurrency. And it's funny because this whole discussion, this entire thing flies in the face of everything that the Bank of International Settlements was just saying. So I'm really glad that we're looking at these two things in tandem. All right. Come back tomorrow and we'll continue with part 4 of our discussion on inflation, the insidious thief. Hope we have a phenomenal Friday. Look forward to the weekend. Actually, not tomorrow because we'll be back on Monday. Not doing the episodes, not doing the podcast on Saturday or Sunday. Just taking the break on the weekends. Have a great weekend. And remember, it's always a great day to earn and stack more crypto. Love and appreciate y'all. Really, really thank you for tuning in. And just hope to see you soon next time. All right. Have a great day. Bye now.